What is a bank reconciliation? Now, bank reconciliations, it is something that I have tremendous amount of experience in, and what it focuses on is the movement of keeping track of the movement of cash that's going in and out of a business account, and you are comparing the cash amount that's shown in the books to the bank balance. And depending on the complexity of the accounts that you're reconciling will depend on how long it would take for you to completely perform the reconciliation. So, from my experience, depending on the accounts, if the accounts are not that complex, it would take maybe 30 minutes to an hour, maybe a little bit more to complete the reconciliation. But with accounts that are very complex, for example, like accounts payable accounts, because there are a lot of transactions that flow in and out of those accounts, those type of accounts, accounts payable, can take days, sometimes months to be honest with you, which it shouldn't take that long, but it can take a long time to complete the reconciliation and complete it properly. So the purpose of it is to account for every transaction that's recorded in the company's books to what's reflected in the company's bank statement. So you're just doing the comparisons, and you just want to make sure that everything is, you're confirming the accuracy and making sure everything is complete. So you are ensuring completeness, and it is a internal control tool, because when you actually are performing a bank reconciliation, you're just trying to prevent or detect fraud. Because when you do bank reconciliations, you can catch fraud or something that's suspicious that is happening here. And also, when it comes to bank reconciliations, there normally are going to be differences between the book balance and the bank balance, and you have to explain those differences. You have to figure out where they're coming from, so that way you can account for those differences either in the current period or in the subsequent periods. Now, this is just an overview of the reconciliation procedures. So, in another video, I want to actually do an example of, or perform an example of, a bank reconciliation. And as you can see here, when it comes to bank reconciliations, there are a few things on each side here. You see, there's something on the left side where it says um, per bank statement, and then on the right side per books. And you see there's some things underneath here for the bank side, and then there's some things underneath here on the book side. So when it comes to the beginning balance that's shown on the bank statement compared to what's shown on the books, in the company's books, they're going to have a difference. I'm never going to say always, but they're going to usually have a difference. And that's okay. That's usually the case, because there are going to be some timing differences between the bank and the book side. And so what your job is to perform the reconciliation, to get the differences, and tie the differences amongst each other to get to the correct balance on each side. So starting with the bank statement. So you're going to start with the balance that's shown in the bank statement. And then the first thing you're going to do is add deposits and transits. So what is deposit and transit? So deposit and transit is when the company here, they make a deposit, let's just say at the end of the month. So they put together a deposit slip with deposits that's going to be made to the bank. And we're going to say they did this at the end of the month. We could say at the end of January. So January 30th or January 31st. Once the company puts together the deposit slips and then has the deposit there, they're going to record the cash deposits in their books as of either January 30th or January 31st. So that increase in cash is already going to be recorded in the book balance that's going to be shown here at the beginning of the bank reconciliation. But on the bank side, it's not going to be shown yet, because once you deposit those, will make the deposits to the bank, it's not going to be processed until after the end of the month. In other words, those deposits are going to come through at the beginning of the new month. So whenever you do this bank reconciliation for example, for the month of January, you're going to have to add the deposits in transit on the bank balance. It's already going to be added on the book side. You need to go ahead and add it on the bank balance for reconciliation purposes. Now we move down to outstanding checks, and they're pretty much different. They're similar to deposit in transit, except that you're subtracting outstanding checks from the bank balance. So on the book side, this is where the company is writing out the checks. They have a lot of checks written, and they are sending those checks away. So as soon as the company writes the checks, they're going to go ahead and report the checks as cash going out already in their books. So those checks that are written is already going to be in the book balance, but it's not going to show up in the bank statement yet if they have not been cashed or deposited in the payee's account. So the checks that are outstanding, meaning the checks that haven't cleared the bank statement yet or the bank account yet, they're going to have to be listed under here as a reduction of the bank balance. So it's already listed as a reduction in the book balance. For reconciliation purposes, you need to subtract the outstanding checks from the bank balance. Then after that, you're going to either add or subtract any bank errors, because banks do make mistakes. I know from experience when performing bank reconciliations, I've had to contact the bank to clear up some things. For example, there may be a check that was for $1,000, but they recorded it as $10,000. They added an extra zero, and so I would have to. Usually, they actually will catch the issue, but if they don't in a timely fashion, which isn't long, it could be maybe, I don't know, within 24 hours. I usually would give them a call just so they know, hey, I see an image of this check. It really was for $1,000. It's not $10,000, and they'll make the change because the check shows that right amount. Now we go over to the book balance here on the book side. So on the book side, there are a few things that occurs that is already shown on the bank side, on the bank statement, but not on the book side. So the first thing here is an addition of the notes collected by the bank. So any notes that's collected by the bank or any interest income that is shown on the bank statement, they're usually shown at the end of the period, which is going to show up in the bank statement. But because it's shown on the bank statement, it's not going to be shown on the book balance. In other words, the company doesn't know what notes were collected, and they're not going to know what interest has been earned until the bank statement has been generated for the period. So in this case, for example, the month of January needs to be completed before the bank statement for the whole month of January to be prepared and completed. And usually the bank statement for the month of January is not going to be populated until the new month, which is going to be in February. So in February, this is where an accountant who's performing a bank reconciliation is going to have to look at the bank statement and notice, oh, there's notes collected and there's interest income there from the bank statement. We're going to have to record it in the book, in the company's books as an addition. And this is something that I had to do on a monthly basis, where I had to wait until the bank statement was populated or generated, and that the bank statement was generated in the new period, but I'm doing reconciliation for the old period. But once that bank reconciliation is generated, then I go there and look at the items that wasn't recorded in the cash account yet in the books, and I just simply record those items in the cash account. So once I do that, then it reflects those items in the books that is already reflected in the bank statement. So it's going to be an addition, the notes collected by the bank or interest income that's collected by the bank is going to be in addition to the bank balance. Now we have a subtraction of NSF bounced checks. NSF stands for non-sufficient funds. This is when you, as the company, have a check and you try to cash that check or deposit that check, but it actually bounced. Once that check bounced, you're going to be charged a non-sufficient funds fee from the bank. That non-sufficient funds fee is already going to be included in the bank statement. Now, the NSF checks, from my experience, the NSF fees can populate at any time throughout the period. So, for example, in January, an NSF check can, or NSF fee can populate, in January, on January 9th, January 10th, January 20th, at any time, any period. But usually you will wait until the end of the period or when the statement is generated, because that NSF fee can actually be resolved within the same period. So what you want to do is actually wait until the bank statement is generated. Wait until the month is over with, wait until the bank statement is generated to see if you have any NSF fees in the bank statement. If you do, again, it's already going to be in the bank statement, but it's not going to be recorded in the company's books yet. So if there is an NSF fee, you're just going to record it as a reduction on the book side because it's already shown in the bank side. Then you're going to subtract any bank service fees. So this is what this is: bank service fees, checks, printing, or other service charges. So any bank fees, account analysis fees, that's going to be shown on the bank statement. When I actually take a look at bank statements, those type of fees, account analysis fees and bank fees, those usually show up at the very end of this bank statement. So at the very end of the month. So for example, on January 31st, that's when you will normally see an account analysis fee or a bank fee. And so because it's already shown on the bank statement, it's not shown on the book balance yet, because you won't know what the fee is until the bank statement is generated, which again is generated in the new period. So once that happens and you look at the bank statement and you look and see that, oh, there's a fee, there's an account analysis fee, you're going to go ahead and record that in the books. All right. Or recognize that as a reconciliation item where you need to reduce the book balance reflecting that account analysis fee or bank service fee. Then, of course, any additional subtraction, which can come from company errors, because yes, people can make mistakes in the company. Yes, accountants can make mistakes. And when you take all of these items into consideration from the bank side, these differences here that occurs on the bank side, and if you take all the items from the book side, all of these differences here, then you should come up with the correct balance here. Now, again, all these items you see here on the bank side, these are items that are already shown on the book balance at the beginning of the reconciliation. Conversely, all of these items that you see here underneath the book balance are all items that are already shown at the beginning of the, bank balance that's shown in the bank statement. So these items here that you see underneath the bank and book balance, these are due to timing differences. So it's pretty common that the bank statement balance at the beginning is different from the book balance at the beginning. But the goal is to take into consideration what is included on the bank side that's not included on the book side, and vice versa, so that you can get to the correct balance here.